Today, we will talk about cum dividend. A stock is cum dividend, which means, with dividend, when a company has declared that there will be a dividend in the future but has not yet paid it out. A stock will trade cum dividend until the ex-dividend date. After that, the stock trades without its dividend rights. When the buyer receives the next dividend scheduled for distribution, the share is cum dividend. Before the announcement of year-end results for companies, dates are set out for closing the register for dividend payments and scrips. These dates will determine the qualification for dividends and scrips. A scrip is a document acknowledging a debt. Companies short on cash often pay scrip dividends instead of cash dividends. Cum dividend is the status of a security when a company is preparing to pay out a dividend at a later date. The seller of a stock cum dividend is selling the right to the share and the right to the next dividend distribution. Cum dividend rights include those associated with the next declared dividend. A declared dividend is the amount the board of directors has agreed upon through a motion authorizing the payments. Once they are declared, dividends effectively function as liabilities for the company. The price of the stock will adjust depending on if it is cum dividend or ex-dividend. Since information on dividends is publicly available, it is incorporated into the share price under the efficient market hypothesis. A strategy of buying at the last possible date, collecting the dividend, and then selling the stock is far too naive to succeed. Let's say an investor owns 100 shares of e-commerce firm Price to Sell, and the company's board of directors has declared a quarterly dividend of 10 cents per share. The ex-dividend date is 10 days away. The investor is considering selling their shares to finance another purchase. If they sell cum dividend, the buyer would receive the 100 shares at the current price and would be entitled to the $10 in dividend payouts. Here are 3 key takeaways. 1. A stock is cum dividend, which means, with dividend, when a company has declared that there will be a dividend in the future but has not yet paid it out. 2. In order to buy a share cum dividend, the buyer must complete the purchase before a certain point in the dividend period, called the record date. 3. Since information on dividends is publicly available, it is incorporated into the share price under the efficient market hypothesis. Hope this would help. Thanks for watching.